Ever since Tricolor Holdings failed and First Brands Group went bankrupt and a bunch of regional banks in the US were forced to book 100% losses on a bunch of their private loans, the private credit industry has been in the limelight. It's been exposed as being fraught with fraud and danger and lies and criminality, and having reporting practices that almost seem purposely designed to disguise the truth and trick the world into thinking everything is okay. But the real risk here is that the legacy media has been actively trying to disguise the true scale of the problem to try and convince you that it's just a few bad apples, that Tricolor and First Brands aren't representative of wider problems in the shadow banking sector, and that all is well. But unfortunately, that just is not the case. And there have been a number of increasingly worrying failures in the private credit market that are going almost completely ignored that I think you have a right to know about. So today, we're going to cover the most recent updates in the private credit world, shedding some light onto the truth of what we're actually seeing, and establish why, no, this cannot be excused as just a few bad apples. Hedge funds with a stake in Brightline's $1.1 billion of corporate debt are crafting a plan to elevate their claims over other similar creditors by offering new financing and concessions. A group of holders of Brightline's corporate bonds due 2030 is proposing a debt deal that could see them extend more capital to the company and permit new equity investments from outside investments. Brightline is a private commuter rail project that's been falling short of projections, and they recently said it's working to issue a substantial amount of equity and has a global process underway to engage potential strategic partners. Such a move would require creditor consent from a group of corporate bondholders who control a majority of the debt. So what is Brightline? It's a private passenger rail company in Florida. It's not state-owned or state-run, it's a completely private company, and it's the only entirely private rail passenger company in the US. And currently, it has a lot of debt. $5.5 billion worth of debt, and it's losing about $70 million every 6 months at the moment. It's been struggling to pay off its debt for already 6 months. They delayed an interest payment on a $1.2 billion bond back in July of 2025. And the fundamental problem here is the company isn't even profitable, let alone profitable enough to pay off its debt, and the solution proposed by the company is to take out more debt to pay off the old debt to kick the can down the road, which is not an unusual thing to hear these days. Now, the numbers are a little bit clouded, and we aren't entirely sure what's going on under the surface, as this is all, of course, within the private credit space, so we really don't know too much about the details, but just one of the bonds is already essentially in default in all but name. Brightline has enough cash in reserve to make payments on $2.2 billion of senior municipal debt and about $1.1 billion of junior corporate notes through 2026, but it's unclear whether the railroad has the roughly $160 million to make a January 15th interest payment on $1.2 billion of unrated junior municipal bonds. Brightline deferred interest on the bonds in July already and can defer 2 more times before defaulting on the debt officially. So currently it seems like they don't have the cash to pay the interest payment on that bond that they already didn't have the cash to pay the interest payment on back in July. And in reality, that's already a default in literal terms, but according to the law, it doesn't count yet. They can in fact delay another 2 interest payments, so they've got another 7 months of leeway on that bond before it's counted as an official default. That basically gives them another 7 months before they actually start making the headlines and you start hearing about them here on YouTube for going bankrupt. Their bonds are already trading at 30 cents on the dollar, showing just how poor their outlook is. And the current proposals for, say, a rescue amount to then kicking the can down the road further. They're raising more debt with a priority to be repaid ahead of the old debt, and then using that new debt to pay off the old debt so they don't officially fall into default. But the simple fact is the company is down on revenue from where they expected to be, and their growth is far too slow as well. They just don't have a real chance to become profitable to pay off all this debt, but the cloudy nature of the private industry allows them to just lie and hide things and raise more debt for a couple of years until they finally fully collapse. This is also literally exactly what happened with the more famous private credit blow-ups like we saw with First Brands Group or Tricolor Holdings. And new evidence has been exposed showing that First Brands Group, they resorted to falsifying invoices and committing fraud to keep the company alive, all the way back in 2022, it just took 3 years for that fraud to become public, showing just how long these companies can hide and obfuscate and disguise their collapse and just keep on kicking the can down the road. Next, we have another under-the-radar problem surrounding a company called Newfold Digital. Newfold, a web services provider backed by Clear Lake Capital and Sirius Capital, will receive $100 million in fresh money through a new first-out term loan, giving some lenders top priority to be paid back in case of a default. BlackRock are also in that upper echelon. The deal also includes a below-par exchange where creditors can be repaid or swap into a mix of senior and junior ranking paper. The lenders that brokered the debt overhaul got the best treatment, whilst others were dealt steep losses, but the finer details of the exchange will likely remain a mystery to debt holders as the terms of these agreements aren't disclosed. Individual lenders had to sign pacts that restricted their ability to compare notes with their peers and then fight collectively for better terms. The non-disclosure agreements also restricted their litigation rights for a certain period of time. Now that's all a little bit complicated, so what does that actually mean? Well, Newfold Digital are basically a company that just sell domains and other incredibly saturated products to small businesses online. Their revenue is actively declining every year, not their revenue growth reducing, but their revenue is actively going down every year, and they don't have any real serious prospect of growing as a business anymore. They also have a huge amount of debt, at least $1.2 billion worth, but we don't know for sure, and there is likely to be even more. And they've just done something really sneaky, whereby they essentially destroyed a load of the value of their old debt and released new debt with a priority to be repaid for everyone else. Now, how did they do this? Well, through some incredibly aggressive negotiations, blocking different creditors from communicating with each other, from valuing their assets fairly. And in the end, all that Newfold Digital actually needed to devalue this old debt and to raise new debt was to get a majority of their bondholders to agree. So companies like BlackRock, who owned most of the debt, they were essentially bribed by Newfold to agree with their proposals to destroy their old debt, to bankrupt those smaller lenders in exchange for BlackRock and others being given an exchange for this priority new debt. The old debt from the smaller creditors who don't control, say, $13 trillion worth of assets, well, they're left in the lurch, able to trade in their old bonds for new bonds after taking a 35% hit on their assets. Essentially, Newfold told their creditors that they're going to default, but they're willing to screw over the smaller players and make sure that BlackRock get their money repaid if they collude with them to screw over the smaller players. That is not exactly confidence-inspiring behavior if this kind of borderline fraudulent and what should be criminal behavior is necessary to keep the company solvent and alive, and it's certainly not a good sign for the future of this company as well. Now, unfortunately, we are now getting evidence that it isn't even just America suffering from this private credit crisis, but that it's prevalent all over the world. And the second biggest market ready to tank, well, it's now China. Now, China Vanke is basically the last big legacy house builder in China. Country Garden, Evergrande, all the other big players you've heard of before, they went bankrupt over the course of the last few years, and Vanke is the only one left. But unfortunately, things have not been going well for them, despite the fact they haven't officially defaulted yet. China Vanke, once the country's biggest developer before it succumbed to an unprecedented property crisis, won last-minute support from creditors to extend a bond grace period in reprieve that it helps avoid a default, at least for now. Holders of Vanke's $2 billion yuan, worth about 284 million US dollars, voted in favor of a proposal to extend the grace period to the end of January, according to a filing on Monday. The company didn't pay the security by its December 15th maturity, which left it in a grace period that otherwise would have expired on Monday. But the challenges aren't over. Vanke's proposal to defer principal payment for 12 months failed to pass, with creditors representing only 20% of the outstanding amount voting in favor, short of the more than 90% that's required. The builder is also trying to persuade investors to accept delayed payment on a 3.7 billion yuan bond that matures at the end of December. Vanke is the last major Chinese real estate firm so far to have avoided reneging on its debts amid the multi-year real estate crisis. Any eventual default of the company, which has $50 billion of interest-bearing liabilities, would mark a new phase in the country's real estate woes that have already prompted $130 billion worth of defaults. So the official line here is that Vanke's still not in default yet, but they're not paying their debts. They're saying that they're not going to be able to pay their debts in the future. So really, the default is just a surface level headline that hasn't been pushed out yet. The reality of the business is it is failed and being crushed under $50 billion worth of debt that it can't pay off, with interest continuing to grow on that date, making the problem worse. Now finally, we have Marathon Asset Management, who gave $1.1 billion as a loan to First Brands Group after their very public collapse a few months ago. Now that loan was supposed to be safe. It had priority repayment terms, so it would get paid off before the $10 billion in other liabilities that First Brands had. And this loan was given after the collapse, so Marathon Asset Management knew full well the state of the company and the problems that it was facing. And now that brand new loan has lost 70% of its value, with the prospect of it being repaid looking incredibly unlikely. And what we're being told by everyone here over and over again is that the private credit crisis is really a fraud crisis and a criminality crisis, and not representative of wider issues within the market. Tricolor and Western Alliance and Zion Bancorp, yes, they all had problems with the private credit loans they gave out. Yes, they've lost hundreds of millions or even billions of dollars. But none of it was because the companies were struggling. No, it was all related to fraud and to criminal activity. So the legacy media is telling us that we shouldn't be drawing any conclusions about the state of the private credit market from these headlines, because they aren't representative of the market as a whole, despite the fact that actually all of the fraud that we are seeing within firms like First Brands seems to have been committed purely to keep the company solvent and alive. But anyway, these new developments, or rather these crises within private credit that we just covered, say Brightline and Newfold Digital and Vanke and Marathon, none of those issues come from fraud or mismanagement, and these aren't even all the new developments. We also just saw a pension fund in Germany lose $1 billion due to its investments, bad investments I should say, in the private credit space. BlackRock bought a company for $12 billion only to find out shortly after that it had lost billions of dollars due to private credit. And what this all really amounts to is just dodgy debt given out to companies that really couldn't afford to repay it and shouldn't have been given the debt in the first place. And the problems have been hidden for years because it's private credit, so it isn't under the same scrutiny as debt in the banking or traditional finance sector, which is exactly what the legacy media and the establishment want us to think isn't happening. But it's getting harder and harder for them to push that line with all the new private credit crises that we keep seeing. Now, I really don't think most people are giving this manipulation of the markets enough attention, especially when considering how prevalent shadow banking and private credit is within the markets and our economies right now. Now, this all relates perfectly to, say, the AI bubble and the circular deal fraud that we're seeing with companies like OpenAI. They're using the exact same tricks. Private companies making private deals, revealing just small random bits of information, seemingly with no logic or transparency, inflating the values of themselves and each other and the stock market as a whole by a ridiculous degree. To the point where right now, about 35% of the S&P 500 is made up of AI hype stocks that could collapse in an instant if the value in this AI bubble is exposed as vaporware or a fraud. And because these deals are all private, coming from private companies like OpenAI, and the other AI companies don't have to tell the truth until it's too late, just like First Brands Group. A quieter trend was unfolding across global markets in 2025. Diversified strategies posted some of their strongest returns in years. It's an achievement that has largely flown under the radar. Multi-asset quant cocktails blending commodities, bonds, and global equities outperformed the S&P 500. An ETF fund holding 29 separate ETFs spanning across global markets posted its best year on record. What we're seeing right now is that the old financial paradigm is changing. Funds that invest into commodities and reduce their exposure to the AI hype and overvalued markets actually outperformed the S&P 500 this year, and it all comes down to a few fundamental changes in the global economy. There is no more free debt, no more 0% interest rate debt, meaning that zombie companies like First Brands Group, they're doomed to fail. We're seeing deglobalization mount, meaning that international supply chains are riskier and harder to make work than ever before, again, just like what we're seeing with First Brands Group. And of course, we've had the passive investing bubble that inflated the S&P 500 and these passive ideas for investing for years and years. That's finally starting to unwind as valuations are just too insane. And all of this is just being outright ignored by the legacy media and the establishment because they have a vested interest in keeping you as exit liquidity, in selling their overvalued assets to you whilst they get out and save their skin and leave you holding the wrong assets as the new financial paradigm emerges. Now, this is a topic far too long and complicated and important for this YouTube video alone, so what I've actually been doing over the last few weeks, the reason I've been posting many videos is I've been putting together and I'll now be running a free online masterclass explaining the new financial paradigm and how to invest in it very shortly. You can register for that free masterclass and save your spot by clicking the link down below in the description and following the instructions on the next page. In it, we'll cover the 3 key changes that we need to be tracking and why they are changing the investment environment right now and how you should be looking at your investments as a result of these changes. But I have to warn you, I'll only be running this masterclass for a few days as we finish up 2025, so make sure to register now and save your space so you don't miss out. Again, to register to save your spot, click the link down below in the description in this video and follow the steps on the next page. Now back to private credit, and what we're seeing distinctly is the market and the legacy media establishment trying to suggest that all of this problem within the private credit space, it's just due to fraud and criminality. Do the recent bankruptcies of First Brands and Tricolor suggest trouble ahead in private credit, coming from a senior investment director in credit investments? No, the recent bankruptcies of First Brands and Tricolor do not signal systemic problems in private credit. Both cases are idiosyncratic, driven by fraud and unique business practices rather than broad market weakness. The entire establishment are all colluding together and trying to astroturf the truth so that everyone thinks this private credit issue is really just an issue with a few bad actors, some naughty people committing fraud. But for example, take First Brands and one of the frauds that we've just found out they started committing in 2022, they were creating fake invoices to try and inflate their assets on their books so that they could take out more debt, not to grow the company, but to pay off their old debt. Yes, that is fraud and criminality, but it's fraud and criminality to keep the company alive, not to try and profit off the back of that fraud. That fraud exists only because the company was failing. It isn't the reason the company is failing. It's the reason it's grown to be such a, massive $12 billion failure and not a $5 billion failure, but it is not separate from the market weakness within private credit. What the establishment are trying to convince us of is that all of these failures and bankruptcies, they have nothing to do with the underlying market conditions like, say, a weak economy or high interest rates or deglobalization. But as the evidence continues to pile up, the fear of another global financial crisis and the criticisms of failed regulators and corruption are finally starting to weigh on the elite's minds. The private credit industry is facing fresh scrutiny from the top global regulators over some of the ratings being assigned to debt in the $1.7 trillion market. The Financial Stability Board, which monitors global risks, has high-level concerns about the potential for rating shopping in private markets, where firms can seek grades on transactions from multiple providers and opt for the most favorable one. Officials at the FSB are also concerned that ratings in private credit are not subject to the same rules as securitization, where safeguards introduced after the global financial crisis typically mandate the use of multiple independent credit ratings and strict management of conflicts of interests. So the Financial Stability Board is an international organization covering the 20 largest economies in the world. It was created in 2009 in the wake of the global financial crisis as an authority to track and to warn us all about these massive problems that took the global economy out back then, and it is now sounding warning signals saying that private credit is seeing ratings shoppings, just like banks did in the run-up to the financial crisis itself with their mortgage-backed securities. Now, does this have the potential to cause contagion to spread out into the rest of the economy and the markets and to impact, say, the traditional banking sector and the rest of the world? Well, sadly, yes. After the implosion of First Brands and subprime car lender Tricolor, 3 private credit executives appeared last month in front of a UK House of Lords committee to hit back at what they called misinformation. What is happening in private credit is fundamentally safer to happen in private credit than on banks' balance sheets. This coming from a Blackstone executive, adding that leverage made the biggest lenders vulnerable to a single point of failure in any of the businesses. The banks, though, disagree. JP Morgan boss Jamie Dimon has described a huge arbitrage taking place as lending moves from the banking sector into more lightly regulated rivals, and recently warned there were more cockroaches waiting to scuttle out after the private credit boom. The reality is lenders and private credit funds are not so distinct. The two have entwined their fates, with banks extending hundreds of billions of dollars in financing that boosts private credit funds' returns. The reality is that banks and shadow banks or private credit today, they're really one and the same. The shadow banks or the private credit lenders, they don't have to follow the same rules, but they're funded almost entirely by the banks themselves, so the risk still lies ultimately with those banks. This chart here shows how a recent Blackstone private credit fund that they did a raise for was funded. And you can see the biggest funders here. $1.5 billion from Bank of America, $600 million from Bank of America, $1.5 billion from British bank Barclays. We have Citibank, we have Deutsche Bank, Goldman Sachs, HSBC, MassMutual, Morgan Stanley, Societe Generale, Wells Fargo. Billions and billions of dollars being flooded from these banks into Blackstone's most recent private credit raise. Almost all of that private credit fund is funded by traditional finance, by the banking sector, by the banks that we all know, that we hate, Bank of America and Goldman and Morgan Stanley. 90% of private credit today exists purely to allow banks to take the same insanely risky bets that they did in 2008, except this time they stick another non-bank entity in between them and the actual borrower to protect themselves from the laws in place that are supposed to stop them from taking on too much risk. And the evidence behind this is incredibly obvious when you look for it. When a private creditor announced that they lost $100 million for a commercial mortgage they'd given out 9 years ago, Western Alliance Bank, they saw their share price drop by 14% overnight. Why? Because Western Alliance Bank had financed that private credit lender and was on the hook for the losses. When Tricolor Holdings fell into bankruptcy, JP Morgan had to come out and say that they will be losing $170 million in the process, despite the fact that JP Morgan hadn't lent any money to Tricolor, but they had funded a private credit fund, which had funded Tricolor, meaning that JP Morgan's books were squeaky clean right up until the bankruptcy couldn't be hidden anymore, and JP Morgan had to book a 100% loss on what they claimed just a week earlier, was a safe and reliable, stable asset. Now, if you want to better understand the markets right now and see why we're watching a private credit collapse and how high interest rates and the death of quantitative easing affects all of this and what's likely to come over the next year, click the link down below and register for my free end-of-year masterclass covering the new financial paradigm we're entering and how to invest in 2026 and beyond. There are only 200 spaces available, so click the link now to register and save your spot for free, and I'll see you on the masterclass shortly. If you want to tell me how right or wrong I am to make a video about something in particular, you can let me know in the comments down below, and if you don't want to miss out on any of my future videos, make sure to subscribe to this channel as well. But if you really want to help me and my channel out and help us grow, send this video to someone else. Click the share button, send this video to a friend, a coworker, or family member, and help educate them on the crisis within private credit and shadow banking as well. There's a nightmare brewing in the private credit and the shadow banking industry right now, and the establishment is playing cover-up. The legacy media, they're trying to disguise the true size of this problem and convince us all that there is no problem at all. But the truth is that the First Brand's collapse is far worse than they previously had feared. We had been assured that a rescue plan was on its way.